Welcome to the weekly update, where I'll go over the action in the market for the week of December 1st through the 5th, and we'll see how things look for December 8th through the 12th. Now, we had a slight up week, and this is after the really strong week that we had for the week of Thanksgiving. And we're not really seeing this in a lot of the commentary that's coming out, but I'm still seeing a real lagging between growth and value, but not in the bigger picture. And it's still holding up okay, but we just want to be aware of this. Now, just this past week on Thursday, the small caps set a new all-time high with the Russell 2000. We still are within less than 1% with the S&P 500. The market's looking pretty solid and pretty positive, and we're coming into a historically more positive seasonal time as we go through December and finish out the rest of the year. But we're still seeing a market that, at least on a short-term basis, it's not as evident here in the weekly charts, but I'll try to point this out. We're still looking more defensive overall. Now, it could be just a basic character shift with the market where instead of large cap growth really leading things, we're seeing the rest of the market coming along as well. There are different phases that the economy goes through, and the market has pretty much figured that it's a done deal that the Fed's going to cut rates this week, another 25 basis points. And that's what's really driving small caps. Mid caps are trying to do okay, but small caps are kind of in favor right now. And we have the January effect, the Santa Claus rally, whatever you want to call that for the small caps. We've seen this over the last couple of years, and then we get into the new year, and that's when it fizzles away. So we'll have to see if something like that develops. But we're looking pretty strong, and the market's not really showing a lot of weakness right now. Now, after we had that big downward move when Powell came out and said, we don't know about the rate cut, we've repaired a lot of damage from a technical perspective, and we didn't do an awful lot of damage in a bigger picture sense, even when we were going down. So, okay, now if you're new to these videos, or maybe you've been watching them for a little while and you want to see if I have anything more than what I just post each day on either YouTube or Rumble, feel free to check out the SPX investing program. It's my program. I developed it. I run the whole thing. And just see if it's something that will interest you. There's additional things that I post there. And for the whole month of December, all you need is an email address, and you can sign up and see if it's something that fits what you're looking for. Okay, so just for the week, then we were up just 0.31%, but still it was an up week. And we were below average with volume. It's been pretty slack in that regard. Pretty every day that we've been improving with volume, but we still are below average with volume. And we're positive, looking pretty good with our charts here. Now, one thing that's happening, at least over the last few sessions, is that we're seeing the 10-year yield actually going up. What we've seen in the past, in the recent past, is when the Fed is getting ready to cut rates, the 10-year yield is going down, and then they cut rates, and then it starts going back up. So that's a little bit different, but we still have until Wednesday of this upcoming week until the Fed actually makes their announcement. We're still not really worried about interest rates. It's just the day before Thanksgiving, we were under 4%. Now we're at 4.11% with the 10-year yield. So it's just like, okay, something going on here. And we're starting to get some economic reports that are showing that the economy is doing okay. Thursday was a bit of a shocker when we had the initial claims. They came out and they saw a real drop. We've been pretty range bound now for quite some time, and it really dropped down big with that one. And we're going to be getting a lot of Fed speak in the upcoming week. They're most likely on lockdown now, so the Federal Open Mouth Committee folks, they can't talk now that they've got a meeting that's going to be starting on Tuesday, and then they'll make their announcement on Wednesday. And then as far as our trend, we're still looking positive. We're not trending on the weekly side. We are possibly starting to develop a trend on the daily side. A very, very weak trend on the short-term chart, daily chart. We're right still on top of the moving average on the intermediate term chart, and we're not trending here on the weekly chart, but we're positive on all three time frames. The green line is above the red line. Okay, so we were up 0.5% with the Dow, up 0.9% with the Nasdaq, up 0.3% with the S&P. And doing quite well. The Russell 2000, as I said, set an all-time high on Thursday. They had a bit of a down day on Friday, but they were up 0.8%. So just some bullet points. And some of these, I don't write this up myself. I'm just kind of paraphrasing from briefing.com. And I'm not necessarily seeing what they're saying in a lot of these statements. And I'll try to point that out. So we did end modestly higher. Okay, you can't dispute that. And we're grinding. We're not really trending. We've been grinding upward despite uneven sector leadership and shifting rate expectations ahead of the upcoming announcement. Okay, that part's okay. Tech and growth areas help support the broader market. They have days here and there, and they're so big, and when they have a good day, they tend to do well. But we look at our growth to value ratios, and they're just not improving right now. But tech is doing all right. Semis are doing really good. The semi to tech ratio is still looking pretty solid. It's mainly the growth to value ratios that I seem to be a little bit concerned about, but it's not necessarily negative in and of itself. We just want to know about this because price is what we ultimately have to follow. And then we were up 3.8% in the semiconductors on the week, and a handful of solid weekly performances by mega caps. Now, again, sometimes the mega caps have a pretty good day. It was on Thursday. They kind of canceled each other out. Some were up, some were down. All right. And then high beta stocks. Now, this has been improving. On the daily side, I show a high beta to low beta ratio. And the high beta stocks are the ones that outperform to the upside when we're going up. They also go down faster when we're declining. And that is true. We outperformed, signaling a continued willingness to be more risk on. And that we are seeing that. But then this weakness in the defensive sectors, not so sure there. Sector leadership was mixed, but tilted towards cyclical. This depends on the economy. It's doing all right. And growth-oriented areas. Now, it's not like growth is falling apart. It's just not outperforming value. But again, that just may be an observation that ends up leading to nothing. But we want to be aware of it anyway. And the broader tone reflected a market that remains generally constructive, and that's true, as we're positioning things ahead of the upcoming week. Rate cut expectations are holding steady. Even though we had the core PCE on Friday, it really didn't change the outlook for the next week's rate cut there. And stocks ultimately found enough support from semiconductors, and that's true. Mega caps, depending on the day, and improved risk appetite. Now, that's the risk on to risk off ratio. It's the high beta to low beta ratio. And that's true. They've been holding up quite well. So here is just the chart. I show it every week. We're still closer to that 3% level. Now, we got core PC on Friday. This is CPI. And we'll see what the next CPI report coming out actually shows us here. But just be aware that the inflation environment can change just like it did back in the mid to late 70s. So here we are back up at 4.11%. Now, a week ago, we were at 4.02. Now, we've been going up a bit here with the 10-year yield, so we're above that 4.02% level. This is where it tends to bite in more to corporate profits. And this chart was not updated. This won't be updated until we get the next employment report. The same with this chart. And then FactSet had one post here. Industry analysts overestimating, or are they, earnings per share for 2026? Well, let's see. I mean, they have it up and to the right. That's looking pretty good now. But at the same time, this is what the market uses. But this is what the initial estimates are looking for as we head off into 2026, and that's positive. All right, here is the intraday chart where we kind of chopped around a little bit on Monday, Tuesday, Wednesday. I've been implementing a lot of market neutral strategies, and they've been working really well because we really haven't been trending. We've been positive, but we haven't been trending. We saw a little bit more of an upward move on Wednesday, but then a sideways day on Thursday. And then this was a little bit disheartening here because there was a lot of anticipation ahead of the core PCE on Friday, and it came in market friendly, and it looked like, okay, here we go. We're going to finally break to the upside here. Well, we just kind of fizzled out and then started to come back down and then went back into a range and just didn't end up closing up all that much in Friday's session. So it's not a market that's negative, but it's refusing to show a lot of strength right now as well. Okay, so for the week, and even though these columns look pretty big here, we had the Dow up here for the 5 trading days, up 1.41%, And then way over here, we were up 2/3% with the NYSE. So this might look a little over exaggerated here as far as the gains, but all of the indexes ended up being positive for the 5 trading days. And then going back to the beginning of the year, small caps are back to being positive on the year, followed by mid caps, where we still have the Nasdaq 100 and Nasdaq first and second, and then in third place is the S&P 500. Sectors, we had an up week with tech. It was doing pretty good there. I mean, it's not falling off a cliff, but it's some of the bigger stocks that we need to see more follow through. We need to see more growth than what we've been seeing because energy was also up on the week, and that's more of a defensive area. Communication, and a lot of that really came in Friday's session where it was up. Discretionary, a bit of an improvement there. And then utilities did take a bit of a hit. Now we're looking okay with that. When we look at the S&P to utilities ratio, the S&P is outperforming. Healthcare still seeing a little bit more profit taking there after the great month in November that it had. Real estate, you would think this might go up a little bit more with the hopes of a rate cut coming up next week. And then staples were down. So when you look at the bigger picture here, we see growth dominating value, but we're just not seeing that flow through, especially to our daily charts. It's showing up a bit more here with the weekly charts. And then the scooter score, we still have tech up in the low 90s now with communication. That's good. And then discretionary, it's coming up a little bit better at 65. It would be nice when these are 1, 2, 3, because these are the big growth areas where healthcare is still looking pretty good in the bigger picture. Real estate is in the single digits as are staples, and those are more defensive. So looking at these numbers, you'd say, okay, yeah, growth is really outperforming value, but the ratios that we look at are just not really improving. Okay, and then the different sectors here, we had tech, industrials, which is more economically driven here, communication, financials, still really underperforming the S&P on the daily side, and discretionary were up, where we had utilities, healthcare, staples. These were the areas that did see some pressure. So looking at this, you'd say, well, yeah, growth really outperformed value. And then year to date, we still have staples, real estate. Those are the two lowest areas where we have tech and communication are up the strongest, and those are growth areas. And then for the week, where we had Nvidia, finally it saw a bit of an advance here. Apple was virtually unchanged. Microsoft was down. So it was really Nvidia that was carrying the overall tech sector, where Broadcom ended up being down for the week. But then the communication, okay, we were up just a little bit here for Google. Meta ended up having a pretty good week, but they're fighting a death cross on their daily chart. And Amazon was down where Tesla was up. Tesla had a pretty good week as well, and that's helping discretionary. And then some more profit taking still here in healthcare. Utilities, all red here. Real estate, a lot of red. Energy, some green over here. And then staples. Other than Walmart, you have a lot of the other areas in the defensive staples area, which are red. Okay, so looking at the relative rotation graph, still seeing healthcare. Still showing some strength over the past year. It's one of the stronger areas, even though it didn't really have a very good week. And we're still continuing to come on with the utilities, rolling over a little bit, but improving with energy, real estate, and staples here. Trying to turn back up with materials and financials and industrials, where we're seeing discretionary and communication showing some weakness now and a little bit of a drop off here with tech recently. So we have utilities and healthcare improving. Tech is more neutral. Then we have the negative areas with the areas that are improving with energy, real estate, and staples. Then looking at the different indexes, where we still have the S&P right around the midpoint here. It's been a lot of 2025, either a little bit below it or a little bit above it. And since we've been going up, it's improving. So it's green and going up. So that's a little bit more positive. We still have the OEX, the S&P 100. That's doing pretty well, but we're trailing off a bit here with the Nasdaq 100, and that's all growth. Seeing and transports had a good week here, and they've been improving as of late. Utilities improving, but now pulling back, and then the Dow Jones Composite also is improving. And then the small caps, I mean, okay, they set an all-time high. Now this is the SML, this is the S&P 600, and it has a ways to go to get to its all-time high. Where the Russell 2000 small cap index, that's the one that set the all-time high this past week. And this one still has a ways to go. Mid caps are still probably the weakest area right now for the index, and it's been that way now for quite a while, last number of months anyway. So we have the S&P 500 and 100, and that's growth and value, and so that's holding up fairly well. Where we're more neutral with the Nasdaq 100, still seeing weakness with the S&P 600 small caps and the mid caps, where an improvement with the Dow Jones Composite, utility, and transports. So sentiment, we did get the latest reading from Investors Intelligence. These are folks that make recommendations. We're back to neutral now with their reading. We had gotten way up above 4, then we started to drop down, and now we're back into about the midpoint now. So we're not getting any much of a lean either way here. And we are improving as far as sentiment. We came in at 40 based on Friday's close, and we were all the way down here to 6. And so the context is that even though it's kind of negative, if you just look at the number, it has been improving as far as the trend. It's been going up, and we tend to go with that. So we're turning more positive as far as sentiment. And then the active asset managers coming out with their latest reading, they're above this 90 level. That's a little extreme there. We could still go higher than where we're at now, but this is when we want to keep a closer eye on this. And they're coming in at 98.57. So that's pretty optimistic because this is basically keying off of the Thanksgiving week when we had that really solid up week. And so a lot of folks are, hey, let's jump on and do the same thing. And then we are coming down with the VIX, with the line chart as well as the bar chart. We're well under 20 there. That's more positive. And we're back to declining. We fell a little bit below the moving average here. When we look at cash to the tech sector, when this black line is going down, that is positive. That means the tech sector is outperforming cash and kind of getting jacked all over the place here with the RIDEX bear bull ratio. They get jacked around a lot, but still tending to be more bullish than bearish right now when you see a lower reading. And we did get a positive reading with the individual investors. They liked what happened the week of Thanksgiving as well. So they're coming in being more net bullish than bearish in the latest reading here. Still on the weekly chart below the moving average. We're coming down and starting to drop below the moving average on the daily side. And not really seeing any concern here with the spread between risky and not as risky bonds. This is the chart that is inverted and this is going up. That means fear is going away. And we like that. That's more positive for the market. And starting to come back down after we had been going up when we look at the VIX and 3-month average of the VIX and then doing a ratio. This coming down and the context that we're looking at it here is more positive. And we're turning back up here. This is a very long-term moving average, 253 periods. That's roughly the number of trading days in a year. And we had been declining, and that's more positive. Now we're ticking up. If we continue to go up, this will probably roll over and start to go back down. And then not really seeing any big changes here with the weekly economic index. Excuse me here. And still below the black line with Chicago National Financial Conditions Index. This is still looking good. We did drop a little bit before below 4%. I know there's a few people that, oh my gosh, it's below 4%. This is just a projection. And the real number is probably going to be quite a bit lower than this. But okay, so we were above 4%. Now we're a little bit below it. All right. I wouldn't necessarily go crazy over that. But this is showing good growth as far as what we're looking at for GDP. And here we're still going up after we had that down quarter almost a year ago. And things are still looking more positive here. And then this is a further breakout. It says the Atlanta Fed's GDP Now model, it dropped um, from 3.5% to from 3.8 to 3 point, but whatever. It came down and some people decided to freak out over that. All right, and then the New York Fed staff, they're maintaining growth really under 2.5% here. So we're seeing a continued discrepancy between New York and Atlanta right now. So this was not updated. That'll be updated when we get the employment report. This was not updated either. This, I have no idea when this is going to be updated. And then looking at the inflation now, we did get the core PCE, so that came in a little less than expected. So we're seeing a little bit of a drop down here, but everything is pretty much flatlined for the time being. And then this is the last look that we'll get, at least in the weekly video, of what's the Fed going to do at this upcoming meeting. 86.4% chance that they're going to cut rates by 25 basis points. Now, according to the market, you would think it was 100%, but no, there's still that 13.6% of folks that think, well, they might not come in and cut rates at all. And if they don't, this could really be bad for the market. And then this has pretty much been locked in now because we had Jerome Powell and some other Fed officials coming out with hawkish comments. And then the week before Thanksgiving on that Friday, and then the week of Thanksgiving, we had more dovish reports that came out. That's what the market has picked up on, and that's what they built the scenario around. So now we start to look at the January 28th meeting. 65.4% saying that rates are going to be the same. If they do cut them, they'll go from 3.25 to 4 all the way down to 3.5. And that's where they think rates will be at the January meeting. But then after the upcoming meeting gets out of the way, then this will become the front month and we'll see how the things shift according to this. And they're pretty much going with that it's probably going to be a rate cut in December. Now it's not looking as likely in January. And still declining with the Fed balance sheet, but it's still going up on a year-over-year basis. There's been some news out there about, and it's not that the Fed is doing quantitative easing, it's that they're not doing as much, if any, quantitative tapering, which is different. They're just letting things fall off their balance sheet now, and they're not really going out and buying anything new. That would be quantitative easing, but they're not. It's kind of slowing down a little bit in that area. And then we're still getting very low readings here with the overnight reverse repurchase agreements. Okay, so our charts here. Coming off of a recent all-time high here with the advanced decline line based on price, we did set a high based on volume. That's a little bit encouraging when we see volume actually outperforming price. So that's bigger picture positive there. And we saw a really nice expansion of the new highs and a bit of a contraction of the new lows, but we're going up with the 4-week chart and the 10-week chart as well. So internally, and this is looking really good on the daily side as well. And in the bigger picture weekly chart, it's looking good here. And we did decline a little bit, but we're still overall quite positive with the short and intermediate term advanced decline ratio. And here's where we're not trending. We're still going down with the ADX below the moving average, but we're positive with the green line above the red line. We're just not trending at this time. And coming down a little bit, but still positive with the Arun, where it's actually turned negative over on the daily charts. And no signal here with the mass index. And here's the daily chart where I've been trying to point out that it looks like we're so far trying to break this series of lower highs that we had been seeing. And we haven't been going up with any real conviction, but we are chopping our way higher for the most part. We're above the 50-day moving average, but you can see the last number of trading days we've been well below average with volume. And I'm still looking good here with the 50-week moving average. It's going up and we're above an advancing moving average. Moving average crossover, still looking really positive here for the S&P. And we were up 0.31%. We're below this overhead pivot point. If we do start to break to the upside, we're going to be watching that. And that's around the, let's see, just about the 7,000 level, which for a lot of folks, that's their target for the S&P. And now we have the 2026 pivot point starting to come into play here. Still looking good, hanging out right around the upper end of this trend line going back to 2009. And then our smart money indicators, we're positive here, even though we were pretty much flat with the boom indicator. We're still above the moving average, but we're still declining with the Chaikin money flow. We're positive over on the daily side, and we're positive here with the Chaikin oscillator, where we switched to negative after Friday on the daily side. So not seeing a lot of confirmation there between these different time periods. We are positive both on the daily side and here on the weekly side with the vortex. Declining, but still above zero with the McClellan oscillator. So we're still above zero with the summation index based on price and volume. That's longer term positive. And the bullish percent index, it continues to do well. Even when we have these virtually unchanged days for the S&P, the bullish percent index is continuing to go up on the daily chart and here on the weekly chart as well. So that means there's some strength going on deeper inside of the S&P 500. And we did decline, but we're still above zero with the swirling trading oscillator based on price and volume, where we continue to be negative on the daily side. And we're above zero here with the price and volume. And the PMO is rolling over a little bit and could be just starting to roll over below its moving average. So that's a little bit of a change there. A bit of a drop down here, but still above 50 with the PMOs that are rising. We're still going up at above 50 with the buy signals, and we're still going up the PMOs inside the S&P above zero. And we're still above the midpoint here with the percent B indicator. And so we're declining here with the slope short term. That's been declining for quite a while. Now we're starting to see the TSI, the other short-term oscillator, it's starting to decline. And now our three intermediate-term oscillators are starting to roll over a bit. And even our longer-term oscillators are looking a little vulnerable. Where everything is switching over to positive on the daily side, it's starting to switch over and look more negative here on the weekly side. And we're positive on the daily side, negative here on the weekly side with the Copic curve. Positive both on the daily side and weekly side with the force index. Still above 50 on the daily and weekly side here with the money flow. And just a little bit of an up week here on the 1 week rate of change. Still looking pretty good here with the 50-week rate of change. We're up at this red line and it had been advancing. And we're above the midpoint with the Stochk RSI. And we're still showing longer term positive momentum with the Williams percent R. And we're above 50 and looking pretty solid here with the RSI 14 week. And we're back above 50 with the ultimate oscillator after briefly dipping below it. And the daily special K chart, excuse me, weekly special K chart here is still positive. And then if we come in and take out the previous all-time high, I'll adjust these fib levels here, but there's really no need to do that until we see what's ultimately going to happen there. And we are positive with the Heiken Ashi. That's looking pretty good on the weekly chart here. We're positive with the Kegi chart. Continue to be positive with the Renko chart and the three-line break chart. And we didn't have any new X's drawn in here. We were just minuscule moves for throughout the whole week here. So nothing from a point and figure perspective changed. And we're a little bit above zero here on the weekly chart for the ease of movement, where we finally crossed back above zero. I believe it was after Thursday. It finally went positive on the daily side. And we're doing okay here with our long-term momentum going up the intermediate term, still declining a little bit here with the short-term momentum. And we are positive for the second week now with the Elder's Impulse system, but we continue to be negative with the parabolic SCR. It is likely that we're going to have to come back and climb up here and take out the previous high for that to put a dot underneath. So the weekly chart is negative where the daily chart is positive. And then we're positive on all time frames here across the different indexes. We're still negative short term based on bonds and the dollar. The dollar's still negative longer term. And here we're just really close to the all-time high here with the S&P. Still have a ways to go with the mid caps, and this is the S&P 600, which has a ways to go for the small caps. And looking good here, not too far from an all-time high with the Dow. Nasdaq still above the moving average, still holding up quite well, up 0.91% for the week, up a little over 1% with the Nasdaq 100. That's still looking pretty solid there. The weekly chart, where we saw three red candles here, and that was pretty negative. Now we've seen two candles going up over the last couple of weeks, and that is positive. Mid cap, still a ways to go to get back to its previous high, but still looking okay, but a lot of sideways action here. And same thing with the S&P 600 small caps, just a lot of sideways action. And the NYSE holding up fairly well in a pretty solid uptrend there. All stocks, US and international, still looking good, setting a new all-time high there. The FANG index has been chopping along. It's above its 50-day moving average on the daily side, and it's still above the 13-week moving average here on this chart, the weekly chart, but we're not showing any real strength here. This needs to kick back into gear to really help the market to go up. And ARK is coming back up and dealing with its 13-week moving average. And the banks, from an RSI perspective, looking pretty solid there. Had a good up week here with the KBW Bank Index. And we're starting to turn back up with the MACD. Here we are in December, going back to 2021. We're up 60% of the time with a return of 0.1%. Not gangbusters, but we tend to lean more positive there. And then the small caps to tech ratio, even with the small caps doing better, they're still underperforming. And this is the IWM that I'm using for the ratio. That's the ETF for the Russell 2000. So you would think this would really start to outperform. It's not when we compare it to the tech sector. Okay, and then the Dow getting kind of close back to an all-time high. Transports, the last couple of weeks, ever since they like grounded Airbus there for a while, and it's like off to the races here. It's been one of the better performing indexes lately, where we've been seeing some weakness coming into the utilities. And then just kind of moseying along, but still in a lazy uptrend here with the weekly chart of the CRB index. Still drifting lower, but getting to the high end of the range with oil. We're back up a little above 60. We're still going up with copper. That's good for the economy. And we're still in an uptrend. But as what we see quite often here, we see a cross and then we see a move in the opposite direction. And that's kind of what's been happening here. We had a golden cross on the weekly chart, and then we've been coming down pretty much ever since then. And gold still has a ways to go to get back to its all-time high, but we're just busting out to the upside like crazy with silver lately. It's set an all-time high this week. And we want to measure the distance above the 200-day moving average with the Dow Jones Semiconductor Index. I show this in the daily videos. We're more than 100% above. Now, we could come up here and camp up here like we have for a lot of 2025. We just want to know about this because a lot of times when the more significant declines start, they start when this is giving us a very high reading above 100%. And we're not even back up to 100% here with the SMH semiconductor, but it still had an up week nonetheless. And looking at bonds based on price, still in an uptrend above the 13-week moving average. Looking pretty good so far with the stock to bond monthly chart after having a nice move up in November. And we have been declining, but over the last few sessions, we're seeing the 10-year yield and all the yields starting to go back up here. And then we're continuing to go up with the Japanese 10-year bond. But it's like, okay, it freaked out the market in 2024. It's not doing anything. Now, the market, the stock market over there is actually holding up quite well. And that might be what's helping to, because I every once in a while I'll see, the carry trade is freaking out. It's going to crash the market. And at some point it might, but what has been happening here doesn't seem to really have an impact on the market, at least to this point. And then we're still looking at gold being up over 60% year to date with stocks in second place, then commodities, then bonds based on price. And we have oil and the dollar kind of neck and neck for what's the least negative here. And then the Nasdaq 100 to S&P. Now it's holding up in the bigger picture. It's still looking all right here. And that's what we want to see in a positive environment. And we're doing okay here, but we've been seeing some sideways action with the S&P 100 to the S&P 500. In gold, it's doing okay, but when this ratio goes up, that means gold's outperforming the S&P 500. And gold has been going up again recently here because it's outperforming the dollar. And growth to value, now it had been pulling back. It is improving. I'll give it that. It's not like it's falling apart. It's just it's not showing the characteristics of really growth majorly outperforming value like we've been seeing over the last couple of years. And that could be just a basic character change of the market because we have to follow what the indexes are doing. And we're still showing where bonds are underperforming stocks here on the weekly side. And this is still continuing to go down. This is low volatility versus the S&P 500. That is positive for the market. Discretionary to staples, not really breaking out, but still holding up fairly well here. And still showing how energy is underperforming the tech sector longer term. And then a long-term chart here, the NYSE breadth thrust here, that's holding up okay. And it doesn't look like we had enough of an upward move in Friday's session to generate the swag NYSE breadth thrust, but this is still quite positive in and of itself. I mean, we had one back on October 10th, and then the market came up out of that and had a really nice move to the upside. Well, this is when we really came down in November. We may not have a swag NYC breadth thrust, but the move up from here can still be positive nonetheless. And we're still working off of the breadth thrust that was generated when we set the lows back in April and then came up out of that. And you can see what the S&P did after that. Still looking at a -4 with the Zohar-Check method. That has not changed longer term. So that remains on somewhat of a sell signal. And we're still going up here with the 50-period moving average of the new highs, new lows. It had been declining. Now it's going back up. That's longer term, and that's positive for the S&P. And we're starting to tick back up with the NYSE new highs, new lows, 50-day moving average as well. And we're going back above the trend line here with the Nasdaq 100. That's showing some improvement there. The ratio between the Nasdaq 100 and Dow still looks really healthy. And the Nasdaq 100, the Qs and small caps, even with small caps, that's IWM. They set an all-time high, but you can see this ratio still favors the Nasdaq 100. And we continue to drop down here with the 3-month yield. All right, and that it's not falling off a cliff like it was going into the great financial crisis, but it is declining. And we're going up, but we started to tick down just a little bit here with the new highs, new lows cumulative for the Nasdaq. Then seasonality, First part of December does okay. It's the second half of December that tends to do better. And going back to 1964, up 70% of the time with a return of 1.2%. And then no matter where you plug in December in the overall equation, it tends to be fairly positive. So whichever one you want to pick out and use to justify things, go for it. We've got major things that we can pull from here. And then this also shows how December tends to perform well, but November tends to perform even better. And then again, as I've been saying over and over here, positive seasonality going into the end of the year. This also shows positive seasonality, as does this chart. And then we have this Hindenburg Omen in the background. Now, the more we get away from this, the more irrelevant it becomes, or the less relevant it becomes. But it can take some time for this to develop here. This is right before the COVID crash. This took a while here to develop at the end of 2021. So we just want to be aware of this. We had the initial spike on October 10th. We've had confirmation spikes since then, and we haven't had any recent spikes here, but it doesn't mean that more won't be coming soon. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.